Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gil Epen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@epen.info. My guest today is Professor David Ikenberry, who was the Chair of Finance at the University of Illinois at Urbana-Champaign and the Associate Dean of the Executive Programs. Later, he served as the Dean of the Leeds School of Business at the University of Colorado, Boulder, and now serves as a full professor in the school. He was an early pioneer among researchers examining long-horizon stock returns, particularly returns subsequent to major corporate news events. Much of his work relates to behavioral finance and the extent to which news is incorporated into market prices. His most noted work has studied open market stock repurchase programs. Welcome, David.
Good morning, Gil.
So you have a paper, I guess it hasn't been published yet, but it's coming out and it's entitled The Persistent Decline in Asset Utilization and the Investment Queue Paradox. And you're talking about the Tobin queue in this paper. So before we get into it, who was Professor Tobin and what exactly is Tobin's queue?
Great question. Jim Tobin is one of the most famous economists in the 20th century. He spent quite a bit of time at MIT. He actually spent some time in Illinois as well. But he had this very insightful idea that a company's opportunities in the future would reveal themselves in the valuation of the company. And that's a very common theme, of course, throughout economics and finance. But if you then take that valuation and you compare it to the replacement costs of building that company, let's say, so you get a ratio, that ratio might typically be, say, in the neighborhood of 1. So if the replacement build the company was in a competitive market the same as its market value, you'd get a ratio of 1. And so the idea was that if that ratio that would happen because the market was seeing great growth opportunities in the future. And conversely, if that ratio was getting low, that was a sign that maybe the market was seeing a lack of opportunities in the future. So for the better part of 50 years, financial economists have really latched on to what's called the Q ratio, or Tobin's Q, or Q more simply, as a measure of growth options and growth opportunities.
So the numerator of this ratio is a market value of an asset. It could be a company. It could be the overall stock market. The denominator is the replacement value, which in conventional companies could be proxied by tangible assets, PPE, those types of things. But in today's regime, where we have most of the value tied up in information, that the denominator is more intangibles, right? R&D, SG&A, and things like that.
Yeah, yeah. So you're really picking on kind of a weak underbelly of Q. Um, the ideas motivating Q, of course, were really robust in the 1950s, 1960s, when Jim Tobin was visualizing this metric. And at that time, of course, the our accounting metrics are pretty good at capturing the replacement value and historic value of those assets. But today it's getting more and more difficult. There are some tools and techniques that are readily used, commonly used in the academic community to deal with this problem. But I think everybody would confess that even though we do our best to deal with it, we may not have a perfect solution. But we do make accommodations for it. And in this work that you're referencing, we work pretty extensively
Yeah, so
with those
intangibles are then
adjustments.
proxied, very simplistically, proxied by R&D and SG&A type investments. Presumably R&D goes into patents and other intellectual property and information assets, and SG&A is going into branding and other type
Right.
of value the company is generating, right? So
That's
so
right.
that when
That's right.
it is
Uh-huh.
greater than one, a market value over replacement value greater than one, the idea here is that if you increase the denominator, if you put $1 into the assets of the firm, market is going to value it at more than $1. So this is almost like a money machine, right? So if it's more than one, it is to the firm's interest to invest more and more. That's the idea.
That's right. That's right. And the firm, not only may the firm invest more, but competitors to the firm may invest more as well. So and the idea is that the market would be rationally understanding that these new entrants would come into the economy as well. And as new entrants come into the economy, that puts more goods and services out there. That tightens up margins, and that reduces profits over time. And then all of a sudden, you can see the value of the firm shrinking, and all of a sudden, Tobin's magic Q ratio has this upside pressure pushing it lower back in that direction of, we'll just use one, we'll call one as some kind of a normal mark. It's not necessarily best to think of it that way, but you can see that there'll be upside pressures to bring it down. And conversely, Gil, if a market is oversaturated and we have too many entrants, too many players in a given industry, let's say, there's too much competition. There's negative rents being generated, if you will. That's gonna compel managers to start liquidating assets and getting out, and that will therefore create kind of a lower boundary that maybe pushes that Q ratio back in the direction of that normal mark, if you will. So the idea is that the market has these natural buffers for having firms invest and disinvest, and competitors also investing and divesting as well,
Right,
to kind of
So
keep
in
the
general,
market in
then,
balance.
in any industry, if you see a Q more than 1.0, that indicates that market has a desire or a hunger for more investment to go into that industry. If it's less than one, it's basically telling the firms to disinvest or not invest at the very least.
Right. All right. I wouldn't get too hung up
Yeah.
on the number 1.00, in a hard way, but I think the idea is that as Q ratios are going up, it's inducing, as you say, more a greater incentive to invest versus Q going down.
Okay. So
A reason to
is it really
divest.
the growth in Q that is more important? Yeah.
it's really the it's really the change when we
Yeah.
think about new investment happening. It's seeing it's watching Q expand, and particularly seeing it at relatively high levels or relatively low levels, and that's kind of what um, that's kind of opening the door to the problem that my colleague and I saw in terms of
Yeah.
trying to start on our
Yeah.
paper.
Okay. So, yeah. Okay. Uh, so, so, um, but you found that the expectation of investment rising and falling with Q is not in the data, right? That's a paradox.
Yeah, well, so that's the paradox. Let me put just a little bit of color on that. So Jim Tobin came out with this theory. It's really it's a very elegant theory. He came out with it 50 years ago in 1969, and it really captured the hearts and minds of lots of economists around the world because of how elegantly it it conveys what market players ought to be doing and not doing. And so for years, it's been kind of the gold standard of what we ought to be seeing in corporate finance in terms of new growth and new investment. The puzzle has been that the data has not complied, and for the better part of 50 years now. To Jim Tobin's credit, in 1969, we actually didn't have the computers and the accounting horsepower to even try to measure this. Um, but once we got into the 1980s, we did, and we started to try to look at the evidence, and so for years we've just had this puzzle about when Q goes up, why doesn't investment go up, and when Q goes down, why doesn't it go down? And for years the thought was, well, maybe we're mismeasuring Q. Maybe there's we were talking about intangibles a moment ago. Maybe that's creating a lot of measurement error noise. Some very heavy hitters at places like Harvard and MIT also were raising questions about, well, maybe the market isn't smart enough to foresee, we're putting a pretty heavy burden on the market to understand all these potential economic forces and rationally price the implications of these market moves. Maybe that's just asking too much of market participants. We found actually a very different solution to this. What we did is, and when I say we, I'm talking about my colleague Gustavo Gurlian at Rice University. Gustavo and I have been colleagues forever, and we were at a conference one time down in Texas, and we were listening to a dinner speaker talk about corporate investment and what companies were doing and not being able to do in terms of generating earnings. And none of this made sense to us. And so we began to use an accounting decomposition of what was driving earnings growth in U.S. companies. And in the process of doing that, we kind of stumbled into understanding what was and what was not driving investment. And we were quickly replicating the results over the last 50 years that Q and investment were not related. But what we did find was that if you take the Q ratio and if you use a DuPont-like decomposition analysis, so for example, the DuPont company years ago took the return on equity measure, and then they began to decompose that into 4 or 5 different variables that when multiplied together gave you the return on equity. But by separating it apart, you could look at each component separately. Well, we took that same idea and applied it to the Q ratio. And so our first variable dealt with this valuation theme. But rather than take the value of the firm relative to its replacement value, we took the value of the firm relative to its total earning capacity, which is not unlike, say, a price earnings ratio. Then the second term was a profitability ratio. So it's the profits of the firm divided by its sales. And then the last term was asset utilization, which is the sales of the company or the sales of an industry or the sales of an economy relative to the total assets of whatever entity. So those three things, if I multiply them together, I get the Q ratio back. But by separating it into three different items, we could actually look and see how independently each of these three items affects investment. And that completely changed that completely kind of opened up the mystery of, or resolved the mystery, I should say, of why Q and investment were not working before. Each of these three things has a little bit of power, but it's really not the market component that's driving it at all. It's really this sales to asset ratio, or another way you could think of it is as capacity utilization. That appears to be the driving reason why companies are investing or not investing.
So just to make it very simple, Q can be, it's maybe similar to P over B, right? Price over book. And you take P over B and you say, P over price, PE ratio, price over earnings is valuation. Earnings over sales is sort of profitability. So PE ratio multiplied by earnings over sales gives you P over S, right? Price to sale, which is also a valuation metric.
Correct.
And the third aspect there is sales over book value. So that is what you're calling asset utilization. How much is the firm generating in sales using the assets it has in the book? Obviously, ignoring intangibles, just to conceptually to understand it. How much is the firm generating in sales?
That's right.
Based on the assets it has in the book. And what you're finding is that ratio has been declining almost monotonically for
Well, yeah, so that's right, Gil. So step one was to understand the drivers of investment. But step two was to try to find out why investment has been declining so precipitously over the last 40 years. Ever since the mid 1970s, investment in the US has been declining. And that was what was kind of creating this paradox. How could it be that investment in the US is falling while the Q ratio has been rising? And when you look at it graphically, Gil, I mean, the numbers just kind of jump off the page. And of course, because of that graph, that's why the relation between Q and investment was broken and why economists couldn't figure it out. But what we're finding is that what's also been going on for the last 40 plus years has been that the sales to asset ratios in the broader economy are declining over time, and they've basically fallen in half. So it's a huge decline. The problem in the U.S. is not that we have too little investment, as a lot of lawmakers would argue today. But unfortunately, the problem is we actually have quite a bit of excess capacity.
Yeah, so we had this sort of the internet bubble, right, in 2000s. So is it that firms overinvested during that time, and those expectations never materialized? Now all the firms are sitting on top of a large asset base, and they don't really need that much of an asset base given the sales that they're generating. Is that a problem?
We we looked at that pretty carefully in our analysis. There's no doubt that the internet bubble is a peculiar window of time, and investment did
Yeah.
increase rather remarkably during that window. But it's not clear at all that that is the driving issue or the driving force. This is really it's a much broader macro trend that extends well beyond that,
So the
unfortunately.
observation that investment rates are falling, it is not in congruence with what you would expect from a Q theory, and you went looking for what might be causing it, right? So one of the things that come up all the time is how managers take actions inside the firm. They look at things in a very short-term window. They are interested in maximizing their bonuses, and and decisions are never really made optimally to maximize shareholder value. So is that something that you're finding in the data or not?
That's a good question. We're unfortunately with the level of detail, the kind of data we have, and the detail that it has, we're not able to really tease apart whether companies have perverse incentive structures that perhaps that may be an extension we can get at in future years, but on the whole, we don't think. Well, clearly, we know that some incentive schemes dealing with particularly managers who are motivated by earnings per share, for example, to set their bonuses. Clearly, we know that's an element that's out there. But it's not clear that it's a major driving force. As best we can tell with our data, it appears that many of these companies that are buying back stock appear as if they were going to be buying back stock anyway. Uh, uh, there are many new studies that are going to be spawned by what Gustavo and I are coming across, and one of these questions is clearly going to be what kinds of firms are trying to shrink their asset base via stock buybacks or dividend payments, and is it being done rationally, or is it being perversely influenced for better or for worse by poorly designed compensation plans? All of these are really interesting questions, but currently, at a 50,000-foot view, these macro trends are dominating these
Yeah.
potential
So
short-term
if I
incentive
understand the
issues.
chart correctly, David, correct me if I'm wrong. So the investment rate has been falling from the 70s. I mean, there are some, localized variations in certain time periods, but in general, from the 70s at 20% to nearly 7% more recently. So it has been falling. From the 70s to the internet bubble, Q has been increasing quite dramatically. And then the market, the bubble burst, Q fell to from more like 3.5 to close to 2.0, and it has been staying at about 2.0 for a period of time. But investment rate continues to fall. Is that thing in the chart?
That's right. That's right. Yeah. If you look, uh, just to kind of quote some numbers here, if you look from, say, 2008, Q is just a little bit north of 1.5. And in 2018, which is the last year we had in our sample, it had risen about 30% to just below 2. But during that same window of time, investment fell from about 11% of assets to about 7% of assets. So again, a
Very
very
huge
huge
shrinkage.
shrinkage.
Yeah. What is your gut feel as to what happened in this shock that we are going through or we just went through? What do you think if we were to look at the data 2019, 2020, what will we see in terms of Q and investment rate? Just as a speculation.
Well, if we were to, I think we would
Yeah.
continue to see more of the same, Gil. I think we would see investment continuing to climb. Now, of course, if you look in the last 90 days, investment has fallen
Right.
off a cliff. I mean, capacity utilization in the U.S. has fallen off a cliff. Um, so, obviously, investment today is shrinking due to tremendous uncertainty and of course, a huge shock to demand. But I think it's puzzling that, if you look at the stock market today, here we are in June of 2020, and by some metrics, the stock market has never been valued higher
Right.
than
Yeah.
it is today. Uh, which it still begs the question: what does the market see? There may be other dynamics that we just don't quite understand, but one of the dynamics we do know in 2020 is that the sales to asset ratios are continuing to go.
Right.
Ratios, whether you look at it from Tobin's Q or if you use something more akin to, say, a price earnings ratio, they've been generally rising over time
Hmm.
while investment's been falling over time. And of course, that's the big paradox that's driving Tobin's Q. Uh, but via this decomposition, where we separate the valuation component, profitability, and asset utilization, we can really see more clearly that the reason investment is going down in the US is that asset utilization is really coming down quite a bit.
Yeah.
In the 1970s, it was actually going up a little bit, but right around 1979, it starts a gradual decline and has been cut almost in half. And you see that whether you use tangible assets as your definition of the value of the firm, or it also you see the same trends if you adjust for intangible assets as well.
Yeah. So it's really puzzling, right? So the stock of assets that firms have, it's in excess of what they need, right? That's what it looks like. And
Yes,
and they have been uh, trying to reduce or reducing investment rate, and with the realization that they got too much to actually generate the sales that they see. And even with this continuous decrease in investment rate, they still have a stock of assets that is too much. Is that what we are seeing?
that's exactly what we're finding ever since the 1980s. What we're finding is that the growth in the asset base of the U.S. has been growing faster than the growth in sales.
Yeah.
And for example, if you start from 1980 through 2018, sales have been outgrowing assets on the scale of about 2 to 2.5% per year.
Mm.
Well, in any one year, that's not a problem. But if you do that for 4 decades in a row, you're going to have an asset base that's just simply too large, and that's really the overall problem that's driving our economy today. It kind of circles back to this comment I had earlier in our conversation that the problem we have today is not that we have too little investment, but rather we've accumulated too much over the last 40 years.
Right, right. So, can we make any judgment or any assumptions around management decision making here? You mentioned some of the incentive problems that may exist in the firm, but beyond that, do we have sort of a decision making issue in the enterprise?
We may. Uh, it's going to
Yeah.
require further investigation to see to what extent that's really the case. Um, to their
Right.
credit, I think we should start with the positive before we swing to the negative. On the positive side, the data here is very, very consistent with what economic intuition would suggest. So, for example, when once you do this decomposition, when valuations go up because the market sees promise in a new sector, for example, you see more investment, and we've seen this in all kinds of industries. This result is generally robust, although valuation, as I said at the outset, is not the big driver. The same is true with profitability. As profitability goes up, that too is a driver of investment, more so compared to valuation. That's all consistent with economic theory and rationale. But this sales to asset ratio is really the key driver. And its impact on investment is so predominant that it's swamping out the effect of valuation and profitability. And that over time has really been shrinking. But the good news is that managers appear to be rationally responding to these opportunities, as economic theory would suggest. Now, for example, why are they overinvesting? That's a whole that opens up, or what appears to be overinvesting. That opens up a very interesting question. Yeah. We don't know. Is it due to incentive problems they have? Is it because, for example, one question we investigate, which we rule out, is maybe it's because our economy is aging. So, for example, as you know, there's some economists have this idea of the life cycle of the firm, that as firms get older, they get a little bit more stale, less nimble, less able to respond to market opportunities. And so therefore, maybe that's why the sales to asset ratios are falling. We investigate this and we don't find that to be the case at all. Adjusting for size of the firm and adjusting for the age of the firm, these results all tend to still be quite prevalent. So it's not clear that that's the driving issue. What the only thing, it's not due to mergers. We thought, maybe there was a big merger wave in the 80s and the 90s. Maybe that was creating an accounting fiction, so to speak, where the assets of the firm would arbitrarily increase to accounting standards, but there was no economic shift, going on. That doesn't seem to be at issue, nor does the trend towards leasing appear to be an issue, nor does the trend towards automation. Many of our industries in the U.S. Have gone through quite a bit of automation. And the idea with automation is if I take, say, if it took 10 people to generate a given level of sales, and now I automate that process and I only need 2 people to generate that same level of sales would be the same in those 2 scenarios, but the assets in the latter case would be much higher due to automation. So therefore, sales to assets would be going down over time. So we looked pretty extensively at automation by looking at the amount of labor versus the amount of capital that goes into our economy. And the numbers just don't add up, Gil. You can't get we know that automation is happening. You walk into a McDonald's and you see automation when you order your Big Mac today. But those appear to be small nips and changes at the margin. There is some literature out there that's suggesting that for all this automation, maybe we're just not seeing productivity gains that would be commensurate with that. So to button up automation, it's just not clear at all that automation is the issue.
To push on that a little further, David, so is it possible that companies invested into technologies that sort of became obsolete? So think about, how we are applying artificial intelligence now. which is very different way of thinking about automation. So the stock of assets that we are measuring in the firm, they're not really productive assets. And I'm including, I'm just making this making this hypothesis just to debate with you. I'm including intangibles in there too.
Right.
So, firms with a lot of researchers, firms with a lot of branding type investments, all those intangibles, all of those things could be obsolete in the new economic regime that we are in which case, the asset base that we are measuring becomes, like you say, more of an accounting figment of imagination rather than a productive asset.
I think we can point to lots of examples like that where, you can say, look, those trends ought to be happening, but and maybe they are at work, but when you step back and you look at what's going on in the broader market, I mean, you still see this big erosion that's just not clear. For example, let's take Walmart. And here's a company that uses lots of technology. But in 1975, they had a sales to asset ratio of 3.7. And in 2015, it had fallen to 2.5. Let's take General Electric. They had 1.5 in 1975 and 0.3. Decline of close to 80% in 2015. As you actually, we were so surprised by this result. We actually, drilled all the way down to the firm level and just looked at, say, the top 25 firms, and about 85% of these top firms all showed a remarkable decline. Procter and Gamble, Johnson and Johnson, Pfizer, Lockheed Martin, Caterpillar, even Apple Computer, which of course we can't go back. We can't go all the way back, but Apple Computer's sales to assets have actually been cut more than half over the last 30 years. So there's something peculiar going on that we kind of need to get our arms around. And it may be an amalgamation of a lot of things, whether they are due to life cycle issues or due to technology. But one thing is pretty clear, Gil, and that is that sales are contracting hard. And so one thing that Gustavo and I did do, and we just kind of knocked on the door to this solution. But there's certainly a lot we need to understand. But economists are just now getting their head wrapped around changing demographics in the world. It used to be that if you look over the last several millennia, population growth has been expanding pretty rapidly, and our economy has really benefited from that expansion. But in 1968, there was an inflection point in the rate of expansion. We went from growing at about the planet growing at about 2.5% per year. That's been cut rather dramatically, and we're actually going down to remarkably low levels that we haven't seen in many, many years. And it could be that we're just not. So our planet is still expanding, but it's in terms of population growth, but it's expanding at a much lower and slower rate. And it could be that as these, kind of like tectonic plate shifts, to the extent that managers are not able to anticipate this issue, or to the extent that managers have a difficult time shrinking the firm. In other words, it's, we think of this as asymmetric investment. It's very easy to expand a company, but it's very difficult to contract it. So it could be that we lock ourselves into an asset base that we just don't need, and therefore, as our economy, as our population begins to slow ever so gradually, we're just not able to contract it fast enough, and that may be why sales to assets is falling. It's again this notion of demographics affecting economic broader economic policies is a brand new subfield within economics just in
Yeah.
the last few years, and this may be an
Yeah, that's a
application of
fascinating
that.
thing to think about, right? So what you're saying is that population growth is slowing all around the world. The growth is slowing. It's still increasing, but the growth is slowing. Uh, and you
That's right.
superimpose on that. Um, I'm just making a speculation here that the 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 power to consume in that population is getting more, um, for lack of term, more varied. So you got, India and China making up about, I believe, about 3 billion people, 2.5, 2.7 billion people. And that is where I think
Right.
most of the population growth is. Europe is declining. US, I think,
Right.
Japan is definitely declining. US, I don't know, maybe flat. So, so it's not only that population growth is slowing, but also within that population, I think the power to consume may be declining even faster. Is it possible?
Yes, it is possible, and one contributing factor for that is we're also
Yeah.
aging at the same time. Um, I don't have the numbers off the top of my head, Gil, but it used to be here in the U.S. I think it was in the mid '70s. Uh, the median age of the U.S. population was about 25 years of age, and today it's almost
Right.
35 years of age. We are aging. Well, it turns out that as we
Right, that's
age,
right.
we tend
You
to
can only
consume
you can
less.
only deal with one
And
device, Gil,
so
not 10 of
that's right. That's right. So, so we're kind of getting a double whammy. There's
Yeah.
fewer mouths to feed, and the
Yeah.
mouths we have are
Yeah.
consuming less.
So that is a trend that we cannot really defeat if that is in fact true. So if your hypothesis is true, then we will continue to see decreases in sales growth, and so regardless of the denominator, regardless of the asset base, managers will be forced to reduce investment rate regardless.
I think we will. Unless there's a some kind of disruptive technology that somehow recasts our economic mold, so to speak. If you look at the huge technology innovations over time, they have driven uh, growth and opportunity, such as, for example, the railroads in the late 1800s, the growth of the interstate automobile system in the U.S. in the 50s and 60s. Of course, the move, the telephone, the radio, the television. These are all leapfrogging technologies that, in small ways and in large ways, drove business. And of course, the emergence of the internet kind of came around as one of those big, discrete jumps in economic capabilities. Absent one of those big changes, I think your prognostication, unfortunately, is right. I think we're going to continue to see gradual declines in sales, and therefore lowering sales to asset ratios, and therefore a lower need to see major corporate
Yeah, and
revitalization.
to make it, we'll get into the positive aspect of it in a minute, but to make it even worse, the the technology discontinuities that we expect to see, at least energy, artificial intelligence, which is largely about productivity. All of those are really on the infrastructure side, not on the consumption side, right? And so
Mhm. Right.
technology discontinuity, even if it arrives, is going to make us even more productive, but it's not going to really increase consumption. So this observation could still remain the same, possibly.
I I think it possibly could.
So
Correct.
the summary of the paper. So you have a new tool here for people to really look at. For instance, you looked at, one of the things that people mention is the share repurchase programs that companies run, and that has a negative influence on investment rate. But you find that that doesn't really explain it, right?
That's right. In fact, Gil, to circle back to the very beginning of our talk, it was around this very issue that Gustavo Grullion and we were listening to this talk in
Yeah.
Texas, as I was telling you, and the speaker was telling us that buybacks were a concerning issue. They were a big part of what was driving all of the earnings growth in 2017, and it just sounded like financial alchemy to me and Gustavo, and it really raised our suspicion that what he was saying really didn't add up. Parts of what he said did add up, but that was what led us into this whole investigation of are buybacks the root of the problem. We got steered off in the direction of understanding Tobin's Q and decomposing it. But once we understood the decomposition of Q and how it affects investment, we had this new tool. And so we turned around and went back to stock buybacks and said, there's a lot of focus on buybacks. In 2019, there were several bills in the U.S. Congress to limit or prohibit buybacks. Are these good things or bad things? And we know on the surface, Gil, that buybacks alone are not driving the investment problem, and the reason for it is the amount of capital going through buybacks is not enough to offset the decline in capital spending that we see. The numbers just don't add up. It's a factor of like 3 to 4 to 1. So buybacks alone are not, buybacks are not displacing investment in a dollar for dollar way, in a causal way. But the next thing we did is said, okay, well, let's control for what we know drives investment, which is, to some extent valuation, to a slightly more extent profitability, but to a large extent asset utilization. And what we found, and then let's in that same model, let's now put in this payout ratio coming across in the form of stock buybacks. And when if you don't do that careful control, you will see that buybacks are associated with what appears to be declining investment. But if you do make those corrections, the influence of buybacks totally goes away. There's no problem whatsoever. In fact, the point estimates are positive, although they're not significant in a statistical sense. So what that's telling you is, yes, investment is shrinking while buybacks are going up, but it's not clear at all that there's any association and certainly no causality that we can statistically show. It appears again that these companies need to be shrinking anyway. They would in say in the 1950s or 1960s, if we were in that time period, we would be doing this via dividend payments. But the reason being that buybacks really didn't exist to a large extent. They did exist, but they weren't ubiquitous in the 50s and 60s. They're much more
Right, right.
common today, of course.
So if I understand your conclusions here, David, it seems to me that just correct me if I'm wrong. So there is a macroeconomic trend in declining population growth rate, declining consumption power in the world, and so we are going to continue to see the ability of firms to generate sales decline because of that macroeconomic trend. And so because of that, we see that an asset utilization, capacity utilization declining because they have a stock of assets that are built up over the years, and managers are correctly responding to it by reducing investment rate. Would that be the right conclusion?
Yeah, I
Okay.
think
Would
you
you?
have it,
What is
Gil.
What do you think to conclude this on this, David? What would you think is the biggest insight from this, and how people should use this tool for, for other things that might be interesting?
I think, Gil, there's a host of questions that this tool can now help us study. I'll give you just a couple of interesting questions. One is, there's a basic fundamental question about whether financial markets channel capital to their best use. It's a very basic question, and up until now, the only tool we had to address that was to look at Tobin's Q. So we would ask questions like, well, if industry X is seeing a rising Q and industry Y is seeing a falling Q, are we seeing more capital go into X and less capital going into, or in fact coming out of Y? That was the only tool we had, and we know that Q is a poor, despite Jim Tobin's elegant theory, we know that's a poor tool to tear into that question. Well, we can now, by using a decomposition, we can far more carefully dissect all that and control for what's happening in the market, control what's happening with profitability, and control with existing capital utilization in given industries, and therefore see if now we have a much better way to see if the capital flows are happening in rational and appealing ways. So that's just one example of how we could use this tool. Another example that comes off of the investment side rather than the corporate finance side is to look at what's happening to the stock market and stock market returns. We've known for many, many years that companies which tend to invest aggressively tend to have poor stock returns over the next several years, 4 to 10 years out into the future. In other words, good capital investment, aggressive capital investment is not rewarded. Conversely, companies that invest less tend to have higher stock returns. So one thing, it's been a real puzzle. It was presumed, for example, that, well, maybe this is just due to managerial hubris. Managers are just, they're too aggressive in expanding the firm, and therefore these negative returns to high investing companies are just payback for bad managerial behavior. But it could be that by understanding the sales to assets dynamics going on here, maybe we can tease this apart a little bit more carefully. Maybe this investment factor is really more tied into a capacity utilization issue, that'll be picked up by the sales to assets. So we think that there's several tools and techniques, but regulators who want to think about tax policy. So for example, should we grant
Right.
accelerated depreciation to advance investment? There's all kinds of tools and I should say
Yeah.
policy questions that this tool can try to help address.
It's but if the sales growth issue worldwide is a macroeconomic phenomenon that we cannot really change, then the question then becomes, how do we maximize within that constraint, right, from a policy perspective? Yeah.
That's right. So again, should we so if we return back to this little micro application that Gustavo and I were working on buybacks, this push by in the U.S. Senate to outlaw stock buybacks is it's going to have no effect, and B, it's potentially stifling, because while the macroeconomy may not be expanding, subcomponents of the economy are expanding. There's always little micro innovations underway. If we limit the flow of capital by capping or prohibiting buybacks, that capital is just going to have to figure out another way to flow into those investments, and it's going to happen. Just putting waving a mandate that says no more buybacks is not going to force investment to go up. And one reason we know this is if you go back to Trump's 2017 tax cut, part of that tax cut was to repatriate capital that was trapped overseas. The tax laws in the U.S. Made it difficult for companies to repatriate funds. Well, in 2017, there was you could think of it as a permanent tax holiday of sorts, and so we had tons of capital repatriated all at one time, and very little of that GIL went into new investment. And that's exactly what we would expect, given what's going on. So just turning on the spigot or dropping capital in helicopters is not necessarily going to change anything.
And as you also demonstrate, David, in the paper, that companies are rich in cash. It's not lack of capital. It just
no, it's not.
Just there is no reason for investment. Yeah,
that's right. They hold more cash today than they've ever held before. So in aggregate, we should say, of course. So it's not for lack of capability.
So this was great, David. Thanks so much for spending time with me, and good luck with everything that you do.
Well, you're more than welcome, Gil, and I look forward to following up with you in future conferences and that.
Great. Thank you.